Hello, I'm Piyush Dave, a fintech professional, and today I'm going to talk about the change in position. That means the change in trade size based on the volatility. If the volatility is too much, then reduce the position size, and if the volatility is very low, then increase the position size. That is a common logic. That means we are going to check the volatility with the logic of ATR. ATR is average true range. If the ATR is very high, that means volatility is very high, trade few units. That means reduce your position size. Like suppose you are working with 100 as a unit, like you are taking a entry with the 100 shares or 100 equity, you try to reduce it to 50 or 25 or 70 based on this ATR. If the ATR is very low, then you can trade more number of units. Like you can trade with your full position size, with your full capital. So that is the basic logic. Now, how we are going to change the volatility? Volatility means change in price. How to change volatility in the market or how to change the price in the market? Now that basically depend on supply and demand. Now, if there is a lot of supply in the market, then the price is going to go down. And how fast it is going to go down is depend on a news which is coming up. So let's consider a simple logic. The logic is if the market is trading like this, a market is trading on some price, and if there is a negative news come, then market will fall like this. Then again it will wait here, and the positive news come, then market will go up, and again the positive news come. So this is basically called as a kind of volatility. If something is happening like this, what we are going to do, we are going to reduce our position sizing. And if the market is in certain range, then we are going to increase our position sizing. So the logic is very simple. Let me explain it one more time. Suppose we consider the market is trading in one range, slowly up, down, up, down. Suddenly a negative news come. Now this is basically called as kind of a volatility has come in the market. So here the ATR score, ATR is going to be very high. It's going to be very high. So on that time, you need to reduce your position sizing. And if the market is stable and continuously either in an increasing trend, so here automatically the ATR is going to low. So on that time, you can increase the position sizing. So it's a very simple logic where the ATR play a very important role. Okay. So first part is how to change the volatility by changing the price, and the price is going to change based on news. I'm going to show a real market simulation for this case. So first we will try to calculate the ATR, and then we will try to understand how volatility position sizing will be changed based on some rule. So first we will try to collect the 15 prices from the market, and after that we are going to find out the true range. So true range means what? What is the change in price from here to here? If this price is suppose 100 and the next price is 105, then the true range is around 5, 10 minus 5. Likewise, we are going to collect these 14 ATR values. That means the previous close minus current close. Likewise, we are going to collect this kind of 14 values from the market. And then we are going to add this 14 ATR, and this is going to be happen in the live market for sure. And after that, we are going to divide that with 14. So we will get the average true range. Once we get the average true range, we are going to find out what is the minimum value of ATR, what is the maximum value of ATR. If the ATR value is minimum and maximum, there is a huge what we can say, range, then we are going to normalize it. Now, what is the meaning of normalization? So first we will find the ATR, then minimum of the ATR divided by max of the ATR minus minimum of the ATR. I'm going to show this calculation in the below part. So first is the current volatility, the lowest volatility in the history, that is 14 cycles, the maximum volatility in that 14 cycles, and what is the ATR score between 0 and 1. We are going to calculate that is ATR in between 0 and 1, and we are going to convert that into percentage. Okay, now let me explain this in a very simple form. If the ATR is very small, it's the safest condition, and we consider, okay, we can trade with full quantity. And if the ATR is very high, that is market is going to be a very volatile, so it's a riskiest condition. So we are going to decrease our position size. So ATR is always in between 0 and 1. Okay. Now once we get the ATR score, after that we are going to calculate what would be the suggested size. So it's 1 comma integer of 100 multiplied by 1 minus ATR score. Suppose ATR score is 0, then 1 minus ATR is 1, and it between 0 to 100. So we are going to trade on complete 100 units. It's a safe market because ATR score is very small. Similarly, if the ATR score is 0.5, then we are going to trade with half of our quantity. So capacity we can consider half of our capacity. If the ATR score is very high, then we are going to trade with very small value of the quantity. We will be in the what we can say in the market, but with a very small quantity. Okay, now let me show this in an actual calculation mode, so you will understand. Suppose we have collected 1, 2, 3, 7, 8 prices from the market. Okay, we consider 8 prices from the market, and the current ATR which we have calculated is 8. Okay, so the latest ATR we have calculated from this sample is 8. Previously it was 8, and new also it is 8. So the minimum value of ATR is 4. Let's consider the max value of ATR is 10, and the current ATR is 8. So first we will try to find out the ATR score, that is ATR minus ATR minimum, ATR max minus ATR minimum. So we are going to get the value as 0.66. Okay, once we get this ATR score, we are going to subtract it with 1 minus 0.66, the ATR score, integer of multiply by 100. So that means this is come out to be 33.33, but we cannot trade 33.33 quantity in the market, so we are going to find out the integer of it. So that means it says, okay, market volatility is ATR score is 0.66. That means you must trade only with 33 quantity, not more than that. That is the exact meaning of it. Okay, so based on this we can calculate with different ATR score what would be the number of unit and the calculation. Okay, let me explain this one more time. So it would be very simple for you to catch all the important concept of how the volatility and other things is being considered. Okay, so I'm going to explain this, the complete calculation one more time with the concept of news flow and other part. Okay, first part, we are going to find out the size of the position based on volatility. Now volatility is depend on price, change of price, and the change of price is depend on the news which is flowing. So in the simulation environment, I'm going to send a different news, and the price is going to act on that different news. And after that, based on this change in the price, the ATR score will be calculated. If the ATR is very high, that means it's considered to be a volatile market. And based on that, we are going to change our size in the actual trade. Like suppose you have capacity of trading 100 unit at the same time, but if you come to know, okay, there is a huge volatility in the market, you are not going to trade with 100 unit, you are going to trade with small quantity of the unit. Now let's consider this first. Suppose you have 15 price from the market, and first you will calculate the TR, then from that ATR, and we are going to normalize the ATR so that we get the exact answer of from the ATR score. Once we do that, we are going to scale the ATR like this. If the ATR is near to 0 or it is 1, then this formula is going to give us the exact quantities to trade in the market. If the ATR is high, then we are going to trade fewer units, less number of unit. If ATR is low, we are going to trade more number of unit. Then once we do that, we have taken this value. Suppose from the previous we got the ATR is 8 and this is the cycle. Now in the next sample, suppose we have the data like this and the current ATR is 8. So from minimum ATR is 4, max is 10, and the ATR current is 8. Based on that, we are going to find the normal, what we can say, normalized ATR score. Once we get normalized ATR score, we are going to find out the suggested quantity from the formula which we have seen. Suggested quantity equal to integer 1 minus of ATR score. So this says, okay, you need to trade 33 units, but 33.33 units is not possible. So that's why we have taken 33 units only. So if the market is, the ATR is very minimum, we consider low volatility, we are going to trade with highest number of quantity. And if the ATR is very much high, then market volatility is on the highest level, we are going to trade with very small unit. We will be in the market, but with very small risk, because the ATR, the volatility is very high. Now I'm going to show this complete part in actual trading environment. So now this is the reason of change of the price. So this is a news flow. I created this window in a such a way that it create a different kind of a news in every 10 to 20 seconds randomly. Now this news may be best news, good news, neutral news, and worst news. Now this is going to be the frequency of coming is different. Okay, so we are going to get like neutral news 40 times, or best news 15 times, or worst news 25 times. Like that, we can get a different kind of a news every time. It give this news randomly. We have no control over it. So once I run this, you can see the news has started. It start generating the news. It's a neutral news. No major update. Business is as usual. Okay, after 10 to 10 second, up to 15 second, like at 14 second or 15 second, is going to generate one more news. Okay, worst news has come. Okay, product is failed. They recall all the product which has been in the market. So now this kind of a news continuously come in the market. Sometimes the news flow is very fast. Sometimes the news flow is very slow. Okay, now it's basically depend on what kind of a business you are running. Okay, so let's consider this news is flowing like continuously in the market in every 10 seconds. What will happen when this kind of a news is flowing in the market? So let me show you what happened when this kind of a news flow in the market with the price. Okay, so let me just adjust this window in a way that I can keep the other window also with me. Okay, so this is my main window. Now the news is continuously flowing. As a neutral news has come. Now this is my exchange. So exchange is going to change the price. Okay, if the best news come, it go 3% up. If the good news come, it is going to go 2% up. If the neutral news come, then it is not going to change anything. Then bad news come, 2% fall. Worst news come, 3% fall. Now this I have decided randomly, like for a best news 3%, good news 2%. It might be more than that also sometime, or less than that also. So let's run this. Okay, now let me keep this both window side by side so that you can see what is happening in the market with the news flow. So this is my window number 2. Okay, this is my window number 1. Okay, there's a neutral news. So there is no change in the price. You can see. Now let's see some changes if there is a positive or negative news come. What is happening in the market? Okay, there's a neutral news again. Okay, no price change. The price is trading in a very small range because the news is neutral. Okay, the bad news has come. Okay, see the market reaction. Market is falling 2% continuous basis because the bad news has come. You can see, just keep on falling like anything. Okay, there's a neutral news come. So market again neutralized, no change in the price. So now based on that, we can calculate the ATR score. Based on that, the ATR score will be calculated. Again, the neutral news. Because we keep the window like this, more number of neutral news should come and less number of worst and best news should come. So that normally market behave work like this only. But the volatility is completely depend on, okay, best news has come, the market is going to go up 3%. You can see the trigger has started, the market is moving like anything to the plus 3% of the value. Very quick. Okay. Again, the behavior, okay, bad news has come again after good news, 2% fall in the market, fast fall. Now this is the highest level of volatility what we are seeing currently. Now I'm going to start my algo, which work with both of them. So first is try to calculate the ATR. Now based on that, okay, again the good news has come. You can see the level of volatility which is coming up. So now I'm going to start my algo. Okay, worst news has come. See the volatility level is on a highest peak. Now on that time, if you're trading on a highest number of quantity, then there's a maximum chance that you might make a lot of loss. So the best way is to work with low number of quantity so that if something happen in trading, still you make a very low loss because the number of quantity which you are trading is very small because the volatility is very high. So now let me show you the algo. So this is the algo which I have written. The logic is it's going to collect the 14 prices, and based on that it is going to trade. It is going to suggest what quantity to trade. Okay, so now the algo has started. Okay, let me close down this. Let me adjust this window. Okay, I'm going to keep all the three windows together. Now this is my price window and this is my news window. You can see it is currently collecting the price from the market to calculate the ATR. The market is behaving on a different news. The worst news has come. The price is been collected in a way that it can able to calculate the ATR. Okay, the ATR is been calculated. The range has been calculated. The ATR is low as per as this calculation. The minimum, the ATR is near to the minimum ATR. So that's why it's suggesting to trade with complete 100 units. Okay, the volatility has started. Volatility has started. You can see once the volatility has started, it starts saying, okay, trade with small quantity, not the 100 quantity. Again, there's a neutral news. Okay, if the neutral news come, the market is ranging trading with small change. Okay, the best news has come again. Best news has come. The market become volatile. and you can see the ATR is increasing. The ATR is increasing and it is trading near to the highest point. So that's why the number of quantity automatically decreases. Volatility doesn't mean that the market should fall. You might have the short position and the market is continuously increasing, then also you might make a loss. So the logic is, if the ATR become high, it says okay, trade with small quantity. You can see the quantity of the trade is decrease. Okay, it says only trade with 20 quantity. If you want to take an entry currently, take with only 15 quantity. So in each and every second, it's continuously monitoring what should be the position size. Now suppose if you are doing it manually, it's almost impossible. This can be only possible with the algo. See, the bad news has come, the market is continuously falling. The ATR is going to be very high. It says, okay, only trade with 12 units. It says, okay, the ATR has reached to the maximum level. Trade with only one quantity. The first news, again, the ATR is going to be very high. The market is falling like anything. Okay, it says, trade with only one quantity. Be in the market, but with very small quantity. The bad news has come, again, the market is falling. It says, okay, trade with very small quantity. Trade with very small. The market is falling. The ATR is at the highest level. Okay. The neutral news has come. You can see if the neutral is coming, the ATR is going to be cool down. Once the ATR is going to be cool down, you can see the number of quantity automatically increase because the neutral news is flowing. Neutral news is flowing again. Okay, the good news. Okay, good news. The ATR is going to be increased for sure. So it is going to suggest less number of quantity. See the beauty of the market. Market is trading. Okay, bad news has come for sure. So it is going to ask us to go for less number of unit. ATR is very small. ATR is very small. Still it's suggesting to trade with small value. See the beauty of algo. Market is changing its price based on this news. The news is so random in nature that we have no control over this news, but the price is going to is reacting. The price is reacting on the news, and based on this news we are going to calculate the current ATR. Okay, it's collecting it from last 14 cycles. If the current ATR is near to the low value, we are going to trade with maximum number of unit. If the ATR is close to the max value, we are going to trade with less number of quantity. A best simulation model in front of you to understand the working of algo in real market scenario. Real market scenario. See, the ATR is at the minimum level because okay, now ATR is going to increase and the size of quantity is going to decrease. You can see there was a worse news come. I hope the concept is very much clear. Thank you very much.